What if I told you a company whose stock has absolutely collapsed by 99% over the last 5 years is quietly up nearly 29% in just the last 90 days? Sounds impossible, right? Well, that's exactly what's happening with AMC Entertainment right now. And this single shift is about to make a huge move that changes the entire setup for anyone watching this stock. Welcome back to the channel. Today, we're breaking down the wild, volatile, and frankly fascinating situation unfolding with AMC. We're zeroing in on a razor-thin window between July 18th and July 21st, 2026, leading straight into a massive Q2 earnings catalyst on July 20th. And while this short-term momentum is already turning heads, there's one explosive options metric coming up in just a few minutes that flips this entire trade on its head. If you're the kind of person who likes catching these setups before the crowd does, do me a quick favor and hit that like and subscribe button right now. It genuinely helps the channel bring you more breakdowns exactly like this one. Now, to understand this sudden shift in momentum, we have to look at what's actually pulling people back into those theater seats. Here's the thing. If you zoom out, the long-term reality of AMC is brutal. A 5-year downward spiral straight into penny stock territory. But something changed recently. The stock is stabilized, carving out a tight trading range between $1.89 and $2.07. And this isn't just random market noise. This 28% rebound is being driven by a powerful operational shift that's finally putting real cash back into the registers. So what happens when you dig into the actual box office numbers? That's where the catalyst becomes crystal clear. AMC just reported its busiest U.S. weekend of all of 2026. We're talking about Disney and Pixar's Toy Story 5 dropping a jaw-dropping $160 million domestic opening. Now combine that with the breakout hit Project Hail Mary sparking a 70% jump in global ticket revenue, and suddenly you've got a genuine recipe for cash flow. But here's the real secret most people miss. Movie tickets don't actually pay the bills. Popcorn does. During that very same weekend, AMC delivered its strongest U.S. food and beverage revenue in over a year, highlighting a massive surge in high-margin concession demand. But could it really be that the biggest players in streaming are quietly admitting theaters still win? It's not just traditional studios bringing people back to the big screen. Streaming giants are now openly conceding that theaters still hold the keys to maximum profitability. Netflix is leaning hard into theatrical releases, granting its highly anticipated Narnia film a 49-day exclusive global theatrical window. And the market absolutely loved this structural shift. AMC stock popped 3% overnight, strictly on that single piece of news. Now, while these growth numbers look incredible on the surface, there's a harsh reality lurking on the balance sheet that we simply cannot ignore. Survival for AMC has demanded a brutal trade-off. Back in June of 2026, the company raised $200 million by issuing over 95 million brand new common shares. And this massive equity dilution triggered an immediate 19% pre-market drop. But, and this is important, this wasn't just cash burn. AMC used that capital to redeem $125,500,000 of their costly senior subordinated notes. By doing this, they effectively pushed their terrifying debt maturity wall all the way out to 2029 and trimmed their annual interest expenses by $7,700,000. But even with that new breathing room, can top-line strength really win a fight this uphill? Let's stay completely objective here. AMC pulls in roughly $4.85 billion in annual revenue with an impressive 67% gross margin. But the cash bleed is severe. They're battling a net margin of negative 10.9%, posting a Q1 net loss of over $117 million. And the real elephant in the room? They're $9.61 billion in total liabilities, with over $7.3 billion of that locked up in strict long-term debt. So with all of that on the table, what is this company actually worth in today's market? When you value AMC purely on its revenue-generating power, it honestly looks insanely cheap. AMC trades at a price-to-sales ratio of just 0.3 times. Now compare that to the entertainment industry average of 1.2 times, or its direct peers trading at 2.8 times. Based on tailored fundamental estimates, the derived fair value for the stock lands right around $2.16. So on paper, at least on a pure revenue basis, it's fundamentally undervalued. But here's the truth. Numbers on a spreadsheet don't buy stocks. People do. And could it be that the people at the very top know something the rest of the market doesn't? We just witnessed a dramatic clash of sentiment. CEO Adam Aron aggressively bought 250,000 shares with his own money, tweeting out, "I ride with you," directly to retail investors. We even saw the infamous inverse Cramer effect kick in, where Jim Cramer publicly called the balance sheet heinous, and retail promptly bought the stock up 7.5%. But long-term holders haven't forgotten forgot in the past. Aaron previously sold stock near $40 a share, and institutional creditors recently cashed out over $72 million. And this deep division in trust, it's perfectly mirrored by the biggest institutional analysts on Wall Street. Because Wall Street is completely and utterly fractured on AMC. The institutional consensus currently sits at an average 12-month price target of $2.09. On the bearish side, you've got Citigroup maintaining a hard sell rating at $1.20. But on the bullish end, firms like Texas Capital and Wedbush are projecting massive upside, with targets ranging from $3 all the way up to $4 a share. Now, none of this matters one bit if we don't look at the actual price action. So what are the charts screaming right now? From a pure technical standpoint, a major stabilization signal just fired off. AMC stock recently formed what's called a golden cross. That's when the 50-day moving average crosses directly above the 200-day moving average, a historically bullish signal. The relative strength index is sitting perfectly neutral at 50. The stock has genuine structural support underneath it, but right now it's slamming face first into near-term friction at exactly the $2.09 level. And here's what makes this so explosive. That technical bottleneck is happening at the precise moment the options market is bracing for an absolute earthquake. Here it is. This is that explosive metric I promised you at the very start. The options market is currently pricing in extreme volatility heading into that July 20th earnings report. Traders are aggressively buying up the $2 straddle, which implies a massive 30% post-earnings price swing. Let me say that one more time so it sinks in. 30%. And it gets wilder. The skew is insanely bullish. There are nearly 59,000 call contracts stacked at the $2 strike, completely dwarfing the put volume on the other side. So if you're already thinking this screams short squeeze incoming, you absolutely need to hear this next part before you make a single move. Let's kill that rumor right here, right now. A structural mother of all short squeezes is highly unlikely. As of the end of June 2026, short interest sits at just 5.96% of the public float. That's actually down nearly 9% from the prior month, with less than a single day needed to cover. What does that mean for you? It means the upcoming price action is not going to be driven by forced hedge fund buying. It's going to rely purely on earnings data and raw technical momentum. So taking every single piece of this data into account, how do we actually trade this thing? This brings us straight to the Q2 pre-earnings trade setup for July 18th through the 21st. Analysts are expecting revenues of $1.46 billion, and we're treating this strictly as a long-only momentum breakout play. The key triggers you absolutely must monitor leading right into the opening bell are the Q2 attendance metrics, the forward guidance on their debt reduction plan, and their ability to defend that critical 50-day moving average. And if those triggers all align, here's the exact tactical execution blueprint you'll want ready. Patience pays here, so listen closely. Do not, under any circumstances, front-run this trade. You're looking for a confirmed entry zone between $2.10 and $2.15, but only upon a heavy volume breakout above that $2.09 resistance wall. If that triggers cleanly, your take-profit target sits between $2.50 and $2.52, which lines up perfectly with the options market's 30% implied swing. And finally, capital preservation is everything. Set a hard stop loss at $1.80 to protect yourself against the downside breakdown below those major moving averages. All right, let's bring absolutely everything together for the final verdict. Before we do, a quick and important note. Everything in this video is for educational and informational purposes only, and it is not financial advice. I am not a licensed financial advisor. Trading and investing carry real risk, including the potential loss of your entire capital. So please always do your own research and consult a qualified professional before making any investment decision. With that said, here's the bottom line. AMC right now is a highly volatile, sentiment-driven trading vehicle. It is not a stable, fundamental long-term investment. For nimble traders with a high risk tolerance, the Golden Cross, those record-breaking box office numbers, and the massive bullish options skew all combine to create a genuinely actionable setup targeting that $2.52 range. But for long-term investors, the constant threat of equity dilution, paired with that $7.3 billion debt anchor, means you should stay entirely on the sidelines until this company achieves sustained positive operating cash flow. Trade the momentum, but always respect the risk. Now I want to hear from you. If AMC does deliver that 30% swing on earnings, do you think it breaks out to the upside or crashes straight through support? Drop your prediction in the comments below. I read every single one. And if this breakdown helped you see the setup more clearly, smash that like button and subscribe so you never miss the next one. I'll see you in the next video.